All right, we're going to talk about net present value, or NPV. Now, before we get into the details, let me give you a bit of an introduction of what the concept really is. And you will soon see that although it is very simple, it is very practical and useful. Let's say a company wants to decide whether they should build another factory, let's say. Or let's say you're deciding whether you should invest in a house to, a rental property, so you can use the rents as cash flows for yourself, right? So a house or any other investment you can think of. So, all these investments, they require some sort of capital, right? Let's call it outflow. So you are going to put in some outflow, and you're expecting all of these investments that you're making to generate some sort of cash flows in the future, right? So let's use a timeline here. So that'll be at time 0, you're going to put some money in your initial capital, and you're expecting the business to generate, in whatever number of years that you're calculating, is going to generate some inflows, some cash flows for you, right? So the whole concept of net present value is going to tell you whether this investment is going to be actually profitable for you or not, right? And not only, you can use it to decide whether to do something or not do something because it's not going to be profitable, or if you're, comparing different investments. Let's say your investment A and investment B, so you want to decide, each of them requires some sort of capital to begin with, and then they return some cash flows into the future. So you want to know which one is going to be actually profitable. And this is where some people confuse this whole NPV concept with the concept called ROI, which is return on investment. And the difference is that ROI tells you in terms of dollar amount whether what was your return on your investment. For example, let's say you invested $1 in something, and then it returned $2 after whatever number of years, right? So ROI tells you, okay, you've made $1 on top of your dollar, so that was 100% return, right? But we are ignoring a lot of things when we are calculating ROI, which is useful by itself, but you got to know when to use it. But if you really want to know the profitability of an investment, what you have to consider also is the time value of money. Okay, my dollar became $2, but after how long? Was it a year, 2 years, 10 years, 20 years, right? It all makes a difference. And also another important factor is that this dollar did not come out of thin air, right? So there are some costs associated with this dollar, right? That is also another factor that you got to consider. So these are the things that using the concept of net present value, we can actually find out whether whatever investment we are taking, is it going to be profitable, considering the timing of the cash flows, the timing that we are receiving any cash flows in the future, and also the costs associated with our capital. So considering all of that, now, is it profitable or not? Which one is better? Which one is going to make me richer, right? So these are all the things that we are going to talk about when we are talking about NPV. Now, here, before I give you the the formula and everything, so let's go over an example. So let's say you are presented with two investments, investment A and investment B. Okay, so investment A looks like this. Investment A at time 0, meaning today, if you want to go with this investment, you have to invest $500 today. So this is your output, your outflow, and 1, 2, 3, and let's say after 3 years the investment will return $1,000. So this is going to be your inflow. All right. Now investment B, same outflow, same investment. So $500 at the beginning, but this one, 1, 2, 3, 4, 5. After 5 years, it will give you $1,350. All right. So $500, $1,000 in 3 years, $500, $1,350 in 5 years. Now you want to decide which one should you go with, right? Which one is better? Now, as you can see here, we are getting more cash, but it's 5 years away. This one is less cash, but it's 3 years away. And we already know, if you have watched the previous videos, you should already know by now that money today is better than money tomorrow because of the time value of money, right? So if you do not know that, please go back and watch the previous videos. Now, the only way, and I repeat, the only way we can find out whether an investment is going to be profitable or not is to compare the cash flows at the same point in time, right? And since we are paying for the investment today, so we got to bring the cash flows to the present time and then compare them, right? So we got to bring these two cash flows also to the present time, right? Then find out the net of the present values. You get it? Net present value. So to do that, we know we are going to need R, a discount rate, right? And I've said this before, but maybe it's not bad to mention it again. When we are talking about R, things that are goes into your R and to their discount rate and has to be considered. Number one is obviously going to be your cost of capital, right? Meaning that, let's say this $500, you're getting a loan, right? And this money has to be paid back. So you're paying some interest on it, right? So that has to be considered. And another thing, let's say you're not getting a loan. The other thing that has to be in there is the opportunity cost of capital. Like I said, let's say you're not getting a loan, but you have other options. So if you put your $500 here, that's the opportunity forgone. If we cannot use it to do anything else, right? So that will be called the opportunity cost of capital that has to be considered. Another thing is the risk of the investment, right? All the investments, we are this $1,000 in 3 years or $1,350 in 5 years, we are forecasting. There are going to be risks associated with each investment, right? So generally, the higher the risk of the investment, the higher the discount rate should be, right? So you'll be compensated, in other words, for the risk that you're taking, right? And the last thing that has to be considered when we are talking about a discount rate is obviously time, right? Are we talking about 2 years or 50 years, right? That the longer that you're not going to be able to have access to your money, the higher the interest rate should be. And we talked about this at the beginning of the course. We call the time premium maturity, and the risk, we call that default rate. So again, you can go back and review them again. So for the sake of simplicity, let's say that you're borrowing this and you're paying 5% on that loan, right? And for everything else, risk and time, let's consider another 5%. So overall, we assume that 10%, because that's an easy number. So we assume that 10% is the right discount rate, considering for both of these investments. And although this one is longer, I don't know, maybe it's less risky. So anyway, we are going to use 10% for both of them. So 10% here. Now we have all that we need to calculate the present value of our inflow, right? So PV of investment A, that'll be $1,000 divided by 1 plus R, that'll be 1.1 because that's 10%, right? To the power of, we are discounting 3 years, so to the power of 3. That'll be 751.31 cents. All right, so that will be how much this $1,000 is worth in terms of today's dollar, right? So that it's worth 751.31, right? So that's how much this is worth in terms of today's dollar. Now I can use this number to find whether this investment makes sense or not. So what I have to do is to find the net of the present values, right? So 751.31 minus 500, that'll be 200. 51.31. Okay, now that is your NPV. That's actually how much you're becoming wealthier by doing this investment, right? After taking into account that you have to pay for the cost of capital and the time and the risk that you're taking, you're becoming richer by this much if you go through with this project. Okay, now let's see about the second project. Like I said, we are going to use 10%. Same, so present value of this cash flow, 1,350 over 1.1. This time we're discounting at 5 years, so to the power of 5. It's going to be 838.24. Okay, now this is worth 838.24 in terms of today's dollar, right? Again, that's what we have to do. Find the net, the difference of these two values. 838.24 minus 500 is going to give us $338.24. Now that is our NPV for the investment B. So if we go through with this one, we are going to add to our wealth by this much, and as you can see, this is a bigger number than this, considering that we are using the same capital in both of them. So this is the one that you have to go with, right? Not this. So as you can see, NPV can tell us comparing when we are comparing two different investments, which one is a better deal. Now, before we go through another example, so we can examine project with different initial capital and different probably discount rate, because it doesn't have to be the same. Let me just give you the rules that we have to consider when we are talking about NPV. So we reject projects that their NPV is negative, right? When the NPV is negative, what does it mean? Let's say if you're, I've said this before, if we increase the interest rate, the discount rate goes up, what's going to happen to the present value? It's going to go down, right? So let's say we increase the discount rate to, I don't know, let's say 30%. Instead of 10, we use 30%, right? Let's say our cost of capital is more, or it's much riskier, whatever. So this number is going to become a number less than 500. We use a number less than 500. What are we going to get here? A negative number. What does it mean? That means if we go with this project, not only we're not going to make money by whatever the negative number we're going to get, that's how much we're going to be owing, right? So we're not going to get richer by doing that project. So we reject projects that they have an NPV, negative NPV, right? What about if NPV is exactly 0, right? And I've calculated this before, so I think about 26%, around that is the right number. If we use a discount rate of 26%, this is going to become 500. The present value of this cash flow is going to become 500. So this is going to become 500, then this is going to be 0. What does it mean? That means whatever we have made with this project is just enough to cover the cost of capital and compensate for the risk that we are taking and time and everything else, right? So we're not going to lose anything in this project, but we're not going to be making anything, right? So it's just enough to cover whatever we have put in, right? So if we get an NPV of 0, we're going to be we're going to be indifferent, right? We're going to be indifferent. And NPV, which is positive, we are going to accept those that they have a positive NPV, like these two projects, right? And obviously, like this scenario, if we are facing with two investments that both of them their NPVs are positive, like these two investments, which one are we going to pick? When it comes to positive NPV, the higher, the better, right? The higher, the better. So that's what we're going to do. Okay, great. Now, before we go and do some, more challenging examples, so let's just keep in mind that when comparing multiple investments, like the one we just did, these are the things that we have to consider. The cash flows each investment will generate in the future. So we got to find out how much the cash flow we're going to be having in the future. So we have to estimate that, right? Number 2, the timing of these cash flows, right? When are we going to receive it? In the 3rd year, 5th year, or few months, whatever, the timing of the cash flows. And number 3, the cost and risk associated with each investment. So these 3 elements has to be considered when we are comparing multiple investments, right? And as for rules, let's repeat them again. We accept positive NPVs, reject negative NPV, and we're going to be indifferent about NPV, that 0 NPV. And let me mention this again. This has a particular name. It is called IRR, and it has different uses. We're not going to talk about it in this fundamental course. As you progress through the course, if you go to the advanced course, we will talk about it. And there are situations that we are looking for a NPV of 0 to find out the internal rate of return, because that's going to tell us about the hurdle rate. So it is useful to know about this. It's not going to be like indifferent. So we have other uses for the 0 NPV, which we will get to in the advanced course. Okay, now let's go through a couple of more challenging kind of questions. So the first one is the NPV of an investment that is paying $1,350 in 5 years, discounted at 15% if it initially cost $500. This is what it looks like on a timeline. So at time 0, we are paying $500, then 1, 2, 3, 4, and 5. After 5 years, we are getting $1,350, right? We are discounting it at 15%. So our R is 15%. All right. So what is the NPV of this project? Does it make sense or not? So what we have to do first is to bring this one right here, right, to the present. So PV of this one will be 1,350 over 15%. So 1 plus R, 1.15 to the power of, this is going to get 5 years, so to the power of 5 is going to be $671.19, right? Now this has to be deducted from this one, so we've got to find the difference. Let me write it here also so we know what we're talking about. 19, we got to find the net of these two, right? So NPV is going to be 671.19 minus 500. We will get 171.19. Okay, so positive NPV, we are going to accept it, but if we are going to compare it to this one, we have to wait and see, right? So the second question, NPV of an investment paying $1,000 in 3 years, discounted at 9% if it initially cost $700. All right. So again, at time 0, now this time $700. It's going to cost us after 3 years, 1, 2, 3. Over here, we're going to get $1,000, right? Does it make sense? R is going to be 9%. So again, we go through the same process, find the present value of the cash flow, bring it here, 1,000 over 1.09 to the power of 3, discounting at 3 years, we are going to get $772.18. Okay. That's how much this is worth in terms of today's dollar. Okay, find the net of these two. 772.19 minus $700. It is going to be $72.18. So here I got it right, 18. Sorry. All right. $72.18, right? So here we are going to get more in terms of NPV. So we are going to become richer, add more wealth to ourselves with this project rather than this one. So we are going to accept this, not this, although both of them are positive, but we're going to pick the one with the higher NPV. There you go. That's NPV. Just one last note. Keep in mind that whenever you're dealing with anything that is, kind of forecasting, an estimation kind of thing. So keep in mind that, these are tools to help us with, estimating the profitability of the project. So, you got to keep that in mind, because if you're off by, a few percentage on your discount rate, or you're estimating your cash flows wrong, so you're going to get a different number every time. And in terms of estimating the correct discount rates and estimating the future cash flows and all that, these are more kind of advanced kind of things. And as you progress and as you accumulate more knowledge, you're going to add more nuances to your calculations, but the bases are the same. We're just going to add more complexity as we accumulate more knowledge. But for now, understanding the mechanics of it is much more important. So NPV is the difference between the present value of your inflows and your outflows.